Joined by Prashant Jain, Chief Investment Officer at 3P Investment Managers. Long-awaited conversation. Thank you so much, Prashant, for coming in. Give us a sense. How are you looking at the markets at this juncture? How are you looking at risk-reward? Just give us that perspective first.
Good morning, Harsh, and
Very good morning,
pleasure
sir.
being here. So, I think I'm quite constructive on the markets. In fact, we have been of the view that the macro challenges that India was facing are clearly now behind us. The balance of payments in the current year should be materially positive, both because of external factors and the steps what RBI has taken. Valuations are reasonable. Stocks have moved to very strong hands from foreigners to DIIs. Multiples are reasonable. So I'm actually quite constructive on these markets.
Prashant, we've seen some bounce back in IT after the recent disappointment in some mid-tier companies like KPIT guidance coming in. What's your view on IT?
I think there is value in my opinion, and I don't think these businesses are going to melt away. And think of it this way that even in the current big time deflationary environment, the top lines are not negative, they're holding on, maybe flattish, maybe very low growth. And I feel that maybe over the course of next year or so, one round of this deflationary pricing would end. Typically, projects have a 3 year cycle, and this deflation started last year. And as enterprises adopt I think they will need to spend more. And I don't think IT budgets are likely to degrow. IT budgets are closely linked to turnover growth, business growth of companies. Yes, of course, they will get more value for the same dollars, but I don't think these companies are likely to report shrinkage in businesses. The challenge, however, is that similar businesses outside India are trading even cheaper. And that I think is a headwind for the stock prices, because when you can buy similar businesses at 20-30% lower multiples, it would continue to pose a headwind for Indian IT stocks till such time there is some change in sentiment. Yes.
So what makes you a buyer, therefore, Prashant, if there is that discount versus global peers? What gives you the comfort that you go out and buy?
See, I mean, I think I we don't know what course things will take when you are getting good value. It is very hard to forecast what course the events will take, how value will unlock itself. So that continues to be a risk. But maybe if the numbers are slightly better than what markets are pricing in, maybe local capital is anyway much larger in India, and they will follow Indian IT a lot more than the global IT because these are part of the benchmarks. Maybe foreign selling stops in these names. Maybe some companies announce screen buybacks, which is now allowed by SEBI. I think some or most of these could prove to be a trigger for these companies. Yes.
Okay. And Prashant, what about some of the niche IT names? Because even they've taken a bit of a beating. The ER&D names. We were speaking with Tata Technologies maybe 3 or 4 weeks ago, and he was suggesting that actually timelines have shrunk, execution timelines because of AI. That's actually a positive. But you've seen some headwind with regard to other commentary coming in, with regard to auto demand, especially from Europe. How do you view some of those moves?
Let me not comment specifically on ER&D names. I don't think I would be able to do justice there.
The other space, Prashant, I want to pick up on is the large private banking space. And you've always maintained the stance that they're undervalued when you look at the price to book right now. Having said that, with the news flow around some of those recently, do you think there's still a value buy?
I shall not always, I haven't said that always. I mean, 5 years back, clearly, I mean, you know what was my stance. These were very expensive for comfort. But yes, I think the last few quarters, 1 or 2 years, there is value. And now clearly There is good value in that space. Bank credit growth has inched up sharply, and last reading I think was 17%, which is very encouraging. And as the FCNRB dollars come in, it will be clearly positive for the banks. And the sector has massively underperformed. It has seen significant selling by foreigners because, I mean, for 20 years or maybe 25 years, this was probably the most overowned sector by foreigners. And we have seen a large part of those positions unwind, which is probably the reason for the massive underperformance that we have seen in this space. Current valuations, I think I would be quite concerned.
You know, with this very swiftly moving market, our definition of timelines as well keeps changing, Prashant. But anyway, that said, you know, the other thing one is wondering, Prashant, and especially the way some of the small and mid caps have actually outperformed since those March lows. Whether you're safer right now in some of the niche mid and small caps, thematic, of course, or would you say the large caps is where you have a larger safety right now?
Sure, in my opinion, as a category, small caps versus large caps, I think large caps are offering better value, to my mind. And they have borne the brunt of the maximum brunt of the selling by foreigners. And as macro turns, as this foreign selling abates, it may over time even turn to positive flows. I think large caps should outperform small caps as a category. But small caps is a far larger, far more diverse companies in that the business outlooks, the growth rates is also extremely diverse. If you look at large caps, the earnings growth will vary maybe between a 5% to a 20% range for the fastest and the slowest growing businesses. But in small caps, it could be the range is far wider. So I think after the significant correction we have seen in small mid caps from the peaks over last 2 years, there is value emerging on a stock specific basis. And I think 1 in 10, 1 in 20 companies would offer good prospects. But then it is each one, I mean, each one's choice, what appeals to someone may not appeal to others. So I think it is going to be a stock picker market as far as the small mid caps are concerned.
Prashant, you know, the biggest debate is about earnings growth between the three pockets, which is the large caps, mid caps, and small caps. Everyone is betting that mid cap and small caps will have a better earnings growth there. Do you think you know there will be a revival of buying interest back in these stocks and especially small caps?
I think small caps have been doing well in the recent past. If you look at very long periods, there is no secular outperformance by the small cap index over the large cap index. There are times when it does better, and there are times when it does not do better. I think the earnings growth per se for large caps should improve now because the underlying economy is doing extremely well. I mean, whatever has been the sentiment in stock markets, but if you look at demand conditions, if you look at credit growth, if you look at GST numbers, I think they point to a very robust underlying economy. The currency depreciation, the increase in inflation, the increase in GDP deflator, all of this point to a higher nominal GDP growth rates in the current year at least. And underlying real growth is also quite strong in my opinion. So I think we could see some acceleration in earnings growth even in the large cap space.
Hmm. And in the sector space, do you see some you know, pullback or recovery coming in the real estate space? Because that was an outperformer last year, and but in the last couple of months, we have seen a lot of correction there.
I think it's a good space, but I, for one, do not track it very closely. So let me not comment on that. Yes.
What about consumption, Prashant? Do you believe that this kind of sideways movement for a prolonged period of time within consumption names, uh, is, it, is, it, is it some way to go in terms of a time and a price correction before you start thinking of them as interesting Is this a good point when you start relooking at them? How should one see those?
The consumption is a very broad spectrum of companies, and you cannot paint all the companies with the same brush. I think consumer staples is a highly penetrated space, and it will continue to exhibit slow growth. It is also seeing challenges from retail, which is increasingly becoming more organized, from D2C, from niche brands, from private labels. So I think that space, to my mind, does not appear to be very appealing. The quality of businesses is extremely good. The cash generation is extremely good. But I think multiples still are demanding and not commensurate to the likely growth rates. But there are many discretionary categories, and I mean, automobiles could be one, airlines could be another. There are many, many categories which are less penetrated, which should exhibit faster growth. These are obviously trading at higher multiples. So one will have to be cautious in evaluating what are you paying and what realistically growth you can expect. So I would be more inclined towards the consumer discretionary space and less towards the consumer staples space.
And so you believe that even within consumer discretionary, is there a preference there, or broad brush what you've given us, broadly would you be looking at those? And even after the kind of rally we've seen, especially in consumer discretionary, you're still very comfortable there?
See, I think it's a fairly broad category. I mean,
Yes.
just start thinking of it. White goods, brown goods, building materials, paints, airlines, automobiles, food delivery, cosmetics, even garment retailing. All of these are discretionary categories. It's a fairly large number, so I don't think it would be right or possible to take a general view on this very diverse set of businesses. But I think as a category, they should grow faster, and the attempt should be to have a realistic view of what growth is sustainable longer term and what is priced. But I think my preference would be to do more work in that space than in the staples space.
Prashant, from when we last spoke, the biggest comfort factor has come in from the crude cool off. I mean, you've now got NYMEX sub 70 and Brent skirting around 70. Tell me, where do you see the biggest commodity cool off gain coming in sectorally?
So I think one, it's not just crude. There are many things. I mean, almost all the challenges that India was facing over last 2 years have moderated, have mellowed down. So look at the biggest challenge to India was the very high level of dollar FDI repatriation. When stock markets were very expensive, MNCs, for the first time in the history of Indian capital markets, diluted stakes big time in Indian listed arms. India was the second highest market for Ps to exit last year. And this is what put immense pressure on the BOP. And that is why the currency was depreciating even prior to the Iran war, prior to the oil prices rally. And of course, FPIs also sold a lot, maybe 40, $50 billion in last 2 years because markets were expensive, no AI plays, and a weakening currency hurt them a lot. I think if you see all of this is now reversing. Primary markets are down. The primary market activity is down, which means the sell downs, the FDI repatriation is much lower. So I think current year India should have a net positive FDI again after 2 years of nearly zero net FDI, which was the biggest challenge. The second source of challenge was gold imports, which moved up from 15, 20, $25 to 60, 70 billion dollars a year. Why? Because gold prices rallied a lot and there was so much money chasing gold. I think gold has clearly broken that momentum. We know what is happening to gold prices. And these prices also are supported by an elevated customs duty. Over time, as this moderates, the rupee price of gold should fall further. So I think gold will draw in far less dollars in the next year or two than what it has done. That could save the country 30, $40 billion a year. And finally, you have the oil price. That scare is clearly gone. And when all of this is improving, I think the FPI flows, outflows should sharply moderate. And I would say that at some point, actually, it should become positive flows. So I feel the macro challenges are clearly behind us. And of course, I mean, I forgot to add what RBI has done. Very simple, very effective steps. Maybe we get 60, 80, $100 billion. So I think the economy is doing quite well. Now, which sectors can benefit from a fall in crude oil prices is clearly the OMCs, some which were significantly impacted. Maybe if metal prices fall, which they have been, maybe some of the user industries like automobiles, etc. But I think these gains are short-lived because ultimately selling prices are linked to costs and costs move in tandem for everyone. But generally, I think it is good for economy, lesser inflation, more liquidity, stable currency. So it would be positive to my mind for domestic cyclicals.
And Prashant, will that really sort of translate into higher gains for equity investors as well? I mean, up until June, the chorus was keep your expectations low for the latter part of this year and perhaps going into next as well. Can we now realistically expect much higher returns at an index level?
Absolutely. In fact, we wrote a note on 22nd of May that this will also pass. And even in the previous quarter's commentary, March ending, we said that we can expect meaningfully higher returns over next 2 to 3 years. My guess would be that Nifty should, over a 3 year period, it has room to deliver 45 to 50% total returns. And this is simply based on some improvement in earnings for reasons I already explained, and that assuming that multiples go back to where they were pre-war levels, which I do not think is asking for too much.
Prashant, you spoke about earnings growth. So, which are the sectors that's going to lead that earnings growth?
Amongst large caps, I mean, sectorally, it makes sense to discuss only large caps. In small caps, it becomes very stock specific, very diverse. I think in large caps, banks should clearly lead. I mean, 17% credit growth and easing liquidity. So I think large banks should be a big beneficiary. I think automobiles, the demand conditions are very strong. Post GST, prices are lower, affordability is good, better liquidity, fuel prices stable, low penetration. I think capital goods should do very well. Demand conditions extremely strong, but in my opinion, it is probably priced in. So these are some of retail, organized retail should continue to grow at a decent pace. Some discretionary categories should continue to grow. Even pharma, I think, should continue to grow at similar rates what it has done over last few years. I think consumer staples, uh, IT, then maybe cement. These are sectors that should grow below average, in my opinion.
Hmm. Uh, and will that give enough earnings growth, and that will bring momentum and foreign flows back?
See, we should not worry too much about foreign flows. I mean, if you look at the experience over last 10 years, I mean, I mean, on a flow basis, the local flows are far bigger than the foreign flows. Just imagine the amount of selling that has taken place last 2 years, and your markets are down maybe 10%. That's not a catastrophe. So I think even if foreign flows do not come back, these markets should do pretty well as they have done over last so many years. Last 10 years, net flows have been very, very small. So I think it is the local flows which are clearly going to decide the trajectory of the markets. And with primary markets being weak, the capital being raised much lower, I think bulk of the local flows should get deployed in the secondary markets. If foreigners continue to sell, it will be easy to absorb those flows. Markets may not move up for some time, but eventually, I think these markets should do quite well because India represents not just the fastest growing economy amongst large economies, but its standard deviation or volatility of growth is also one of the lowest in the world. So, I mean, okay, in an environment where AI earnings are growing much faster, where memory prices are 5, 6 times, India may look less attractive uh, in this environment to a foreigner. But these memory prices, I don't think will stay this way forever. It is a deep cyclical sector. It will turn, and when it turns, the linear growth, double digit, what India offers will start looking pretty attractive. So I think at some point, even foreign flows should come back, though I don't think they are the real, they carry the same influence on markets what they used to 15, 20, 30 years back.
Absolutely. So, Prashant, the learnings from all through last year up until March have been diversification in asset classes, in geographies. Gold, silver gave you much better returns than any other asset class. Geographical exposure to other countries as well fared very well. Now, from this July to next, do you think a higher equity exposure purely in Indian equity markets would work better as opposed to diversification or higher allocation to any other asset class?
See, I think Indian equity should surprise us on the upside, both in absolute and relative to many of the assets categories that you mentioned. So, India's underperformance is temporary. It is partly to do with elevated valuations 2 years back, which, again, if you read our commentary of September 24, we had mentioned that Nifty is overvalued. I think we have undergone a lot of correction since then. Gold, I think, as an asset class, has displayed very long cycles. And after what has happened, I think it may not perform for many, many years. This AI, I mean, time will tell whether it is an excess, whether it's a bubble. I really don't know. But I think even if, I mean, AI as a technology will continue to grow and evolve, I am sure. But there will be a time when stock prices stop performing, outperforming. And I think again, focus will come back to the linear businesses that India offers. So I remain quite optimistic both on the India's economy and the medium to long term prospects of our markets. Of course, we have to be mindful that India does not have meaningful innovation yet. So you cannot have disproportionate gains what you could make in technology innovation driven companies. So as long as your expectations are realistic on India, I think we should be fine.
Right. Prashant, so good having you on the show today and getting that very, very clear perspective and a very optimistic perspective on the markets. Just what investors wanted to hear.
No, thank you. Thank you for inviting me. Pleasure.
Okay, that's Prashant Jain. Conviction call there.